fixed assets accounting, and the topic is very interesting in this module, which is exchange of asset. Mostly the youngsters do this type of transaction, especially in these days. They give their old mobile and exchange with a new mobile set. You do it? Okay, so this is what we are going to learn. That what accounting you do when you exchange your old asset with the new asset. Okay, so it should be very much interesting for you. So please be attentive to learn accounting. So the scenario or the concept that we will be discussing over here is that when an old asset is exchanged with a new asset, the seller of new asset will offer an allowance while receiving payment from selling asset in consideration of the exchange of old asset. As I told you that you had an old asset with you and you are exchanging it with your new asset. So the seller from whom you are buying will offer you an allowance. Okay? Means this is the allowance that he will tell you that would be subtracted from the price of the new asset. Okay? So while receiving payment, the seller will do, while receiving payment for selling asset in consideration of the exchange of old asset, such allowance is known as trade-in allowance. Okay? So that is known as technically trade-in allowance. Okay. Well, so the buyer will subtract this trade-in allowance from the cost of new or the price of new asset while making payment. Okay. So if you are buying an asset, its price is supposedly 100,000. You are buying a phone for 100,000 and the old phone for the new phone set, for the new asset. Your old asset was valued at rupees supposedly 30,000. So how much you will be paying now? Yes, you will be paying cash 70,000. So this would be your cash. And this 30,000 would be your trade-in allowance. Got it? Yes, this is what we are discussing now. So although you are not receiving this 30,000 in cash, but you are saving this 30,000 by giving your old asset and buying the new asset. Well, so this is what like you will be working out. That cost of, if these are the three information, okay. If any two information are given, the third you can calculate. Supposedly if cash consideration is given, okay, and trade-in allowance is given, so you can calculate cost of the new asset, like trade-in allowance in our example, what we just discussed. How much was the trade-in allowance? Yes, you are right. 30 was the trade-in allowance. Okay. And how much you were paying? 70,000 you were paying. So the cost of new asset is worked out as equal to 100,000. Okay. And if cost of asset is given, supposedly 100,000, and trade-in allowance is given, supposedly 30,000, so how much would be the cash consideration that you would be paying? Is 70,000. Why we need to calculate all these figures? Because this 30,000 trade-in allowance is taken as sale proceed and should be shown in the asset disposal account. And this is the cash which is to be shown in the cash book as payment. And this is the cost of new asset that should be shown in the fixed asset account. So it will be taken to the disposal account. It will be taken to the asset account. And it will be taken to the cash book. Got it? This is its importance. All right. So let's see over here that asset account will be debited with the cost of new asset and cash paid plus trade-in allowance will give this cost. Okay, and trade-in allowance is considered as disposal proceed of the old asset. This is what I discussed with you in these two equations. All right. And then there is a commercial substance thing that, in fact, we discussed in the earlier module when we were discussing the definition of few items, few important things of property, plant, and equipment. This commercial substance means what? I will discuss it in this section. Now, please be attentive. When an asset is exchanged with another asset, you are exchanging an asset with another asset, and commercial substance does not exist. Okay. In such exchange, the cost of asset taken through exchange is the carrying amount of the asset given up. But when commercial substance does exist, I will tell you what is commercial substance. So please be patient. Okay? I can understand what is going on in your heart. Okay. So, but when the commercial substance does exist, okay, here does not exist, here does exist, then the cost of asset taken through exchange would be fair value of the asset given up. Okay? Fair value of the asset given up. So, in these two paragraphs, main concentration is if commercial substance is not existing in the exchange transaction, then carrying amount of the asset given up would be the cost of the asset taken. Whereas, if commercial substance does exist, then cost of the asset taken would be the fair value of the asset given up. Okay? So remember this thing. When fair value of both asset is not determinable, for example, there would be a scenario when we cannot determine fair value of the asset given up, then the carrying amount of the asset given up would be considered as cost of the asset. This is the situation practically the accountants face. Now comes what is commercial substance. Existence of commercial substance means that the entity specific value, now it's little technical thing, entity specific value, which is the present value of future expected cash flows associated to that asset, are not equal. Okay. So in this case, we will say that commercial substance is existing. Okay. Means commercial substance means that commercially both assets are having different pattern of benefit, let me say, or different value for your business entity. That's why it is also known as entity specific value. Okay. So if the entity specific value for those two assets, what we are exchanging, is different, then it means there is a commercial substance. And if there is a commercial substance, the cost of asset would be fair value of the asset given up. And if there is no commercial substance, then the cost of asset would be carrying amount of the asset given up. All right. So the important tip to remember for all this disposal accounting is, in one single entry, that provision for depreciation debit, cash or trade-in allowance or accounts payable or insurance claim is debit, and income statement for loss is debit, fixed asset is credit, and income statement for gain, if any, is credit. As a matter of fact, this is what we have already done in the earlier modules. Here just I'm giving you a tip that with this accounting entry, our provision for depreciation account will get nil. Our asset account will also get nil. Okay? And the cash or trade-in allowance or accounts payable or insurance claim, whatsoever we will be receiving, will be debited. Okay? And ultimate effect will be going to the asset disposal account. In this accounting entry, you see, we are not debiting or crediting asset disposal account. Rather, directly, either this loss figure will be appearing or profit on disposal will be appearing. So either of these two will become the part of this accounting entry. Okay? So either there will be a loss or there will be a gain out of this disposal accounting. All right? Well, so this is what you have to keep in your mind as a tip, along with one more tip. That what is fair value? Because we were using this word fair value in that commercial substance thing. Fair value is in fact the price that would be received by selling the asset, okay, in the market in an orderly transaction on a measurement date. Okay, the date on which we are measuring fair value, when this is the price we are receiving by selling the asset in the market. It is simply, you can say, the expected selling price. But there are few conditions which are given in this definition that we have to take care. So this is the fair value. All right, thank you very much. This is all about your syllabus for fixed assets accounting. Thank you.